What inflation really means. At its simplest, inflation is the general increase in the prices of goods and services over time. It means that the purchasing power of money declines. A dollar today buys less than it did yesterday. Economists track inflation using indexes such as the Consumer Price Index, which measures the average change in prices for a basket of everyday goods. But inflation is not just a statistic, it is a lived experience. It changes how people spend, save, and plan. It erodes savings if interest rates do not keep up. It distorts wages, rents, and contracts. When inflation is high, it becomes not just an economic problem, but a psychological one. People begin to expect higher prices, and those expectations themselves drive behavior that makes inflation worse. A world where prices rise slowly. Most modern economies expect a small amount of inflation. Central banks usually aim for around 2% annually. This level is considered healthy. It encourages people to spend and invest rather than hoard cash, and it gives businesses some incentive to grow. A little inflation oils the gears of the economy. But when inflation surges beyond that modest target, it creates instability. People struggle to budget. Workers demand higher wages to keep up with costs. Businesses raise prices to cover wage increases, and the cycle accelerates. When prices rise faster than incomes, the standard of living falls. The classic causes of inflation economists typically divide the causes of inflation into two broad categories. The first is demand pull inflation, which occurs when demand for goods and services outstrips supply. Imagine a booming economy where jobs are plentiful, wages are rising, and consumers are eager to buy. Stores cannot stock enough. Factories cannot produce fast enough, and prices rise in response to the demand surge. The second is cost-push inflation, which occurs when the cost of production rises and businesses pass those costs on to consumers. A spike in oil prices, for example, makes it more expensive to transport goods, which pushes up prices across the board. Likewise, higher wages or raw material shortages can create cost pressures. Sometimes inflation comes from a combination of both forces. An economy might experience strong consumer demand while also suffering from supply bottlenecks, creating a perfect storm of rising prices. Money supply and inflation. Another crucial driver of inflation is monetary policy. When a central bank increases the supply of money too rapidly, more money chases the same amount of goods, leading to price increases. History provides dramatic examples of this phenomenon. In Weimar Germany after World War I, excessive printing of money to pay reparations led to hyperinflation so severe that people carried wheelbarrows of banknotes to buy bread. Modern central banks are more cautious, but the link between money supply and inflation remains important. When governments inject liquidity into economies during crises, as they did during the global financial crisis of 2008 or the COVID-19 pandemic, they risk fueling inflation if demand rebounds faster than supply can adjust. Globalization and supply chains. The modern economy is global, and inflation cannot be understood without looking at international supply chains. When goods are produced in one country, assembled in another, and sold in a third, any disruption can ripple across prices worldwide. For decades, globalization kept inflation low by allowing companies to source cheaper labor and materials abroad. But when global trade is disrupted by pandemics, geopolitical conflicts, or shipping bottlenecks, the effect can be sudden and sharp. Shortages push up prices, and the interconnected nature of supply chains means no country is immune. Energy prices, the hidden driver. Few factors influence inflation as dramatically as energy prices. Oil, gas, and electricity underpin nearly every part of modern economies. When oil prices spike, transportation, manufacturing, and even agriculture feel the effects. Consumers pay more at the pump, but also more for goods transported by trucks, ships, and planes. The energy crises of the 1970s are classic examples. When oil exporters cut supplies, prices quadrupled, leading to soaring inflation across Western economies. Similar dynamics continue today. When energy markets tighten, inflation follows, wages and expectations. Another important piece of the puzzle is wages. If workers expect prices to rise, they demand higher pay. Businesses, facing higher payroll costs, raise their prices to maintain profits. This wage price spiral can become self-sustaining. The psychology of inflation is as important as its mechanics. Expectations shape reality. Central banks therefore monitor not just current inflation but also what people believe about future inflation. Anchoring expectations is critical. If the public trusts that inflation will return to a manageable level, they behave accordingly. If not, inflation can become entrenched. Historical lessons. The history of inflation offers cautionary tales. In Latin America during the 1980s, several countries experienced hyperinflation that wiped out savings and destabilized governments. In Zimbabwe in the 2000s, inflation reached absurd levels, with prices doubling every day. These extreme cases show the destructive potential of unchecked inflation. But even moderate inflation can shape history. The post-World War II boom in the United States was accompanied by inflation that, while not extreme, altered consumer behavior and monetary policy. The 1970s oil shocks forced a re-evaluation of energy dependence and led to the rise of inflation-targeting policies. Why prices feel sticky? Even when inflation slows, prices often remain high. Economists call this price stickiness. Businesses are reluctant to lower prices once raised, especially if consumers have already adjusted their expectations. Wages rarely decrease either, meaning that downward adjustments in costs are slow. This stickiness means that while inflation may ease, the high cost of living can persist. For households, it creates the frustrating sense that once something becomes expensive, it never quite becomes affordable again. Modern inflationary pressures. In recent years, multiple forces have converged to push prices higher. The pandemic disrupted supply chains and reduced production capacity. Governments and central banks responded with stimulus measures that increased demand once economies reopened. Energy markets became volatile due to geopolitical conflicts. Housing shortages pushed rents upward. Together, these pressures created a surge in inflation that touched nearly every part of daily life. For many families, the result was painful. Essentials like food and fuel consumed a larger share of budgets. Rising mortgage rates made homeownership more difficult. Even small luxuries like dining out or entertainment began to feel burdensome. The role of central banks today. Central banks are tasked with controlling inflation, often through interest rate policies. By raising rates, they make borrowing more expensive, cooling demand and slowing price growth. But this tool has limits. Raise rates too much, and economies risk recession. Raise them too little, and inflation remains unchecked. The challenge is striking a balance. Policymakers must weigh short-term pain against long-term stability. Their decisions ripple through housing markets, stock exchanges, and global trade. For ordinary households, these choices determine mortgage payments, job prospects, and savings returns. Inflation's social consequences. Inflation does more than shrink purchasing power. It reshapes societies. It widens inequality, as those with assets like property or stocks may see values rise, while those relying on wages fall behind. It erodes trust in governments and institutions when people feel economic management has failed them. It fuels political unrest, as citizens demand relief. In extreme cases, inflation can topple governments or trigger revolutions. Even in moderate cases, it changes how people live, from how they shop to how they save for retirement. Inflation is thus not just an economic story, but a social one. The future of inflation. Will prices ever stop rising? Economists disagree. Some argue that inflationary pressures will persist due to demographic shifts, climate change, and geopolitical realignments. Aging populations may strain labor markets, while climate disruptions could make food and energy more expensive. On the other hand, technological advances may offset inflation by boosting productivity and lowering costs. The story of inflation is the story of why prices never seem to stop rising. It is about the clash of supply and demand, the fluctuations of energy, the psychology of wages and expectations, and the policies of central banks. It is about history repeating itself, with each generation facing its own version of the same challenge. To explain inflation is to explain more than numbers and charts. It is to explain the tension between stability and chaos in economies, between prosperity and hardship in households. Inflation is at once a technical concept and a deeply human experience. When we ask why prices won't stop rising, we are really asking how societies manage scarcity, abundance, and the constant struggle to keep balance in a world that never stands still.